right, so let's begin. Balance Advantage Funds, or BAF as they are commonly called, works with an aim of balancing investors' risk and return, ensuring that the investor gets the advantage of being exposed to equity and debt during market movement change. Now, these funds are a part of hybrid mutual fund category, and the fund manages the allocation between equity and debt. So let's understand this category better. And the fund in focus today I'll be talking about is Nippon India Balance Advantage Fund. And to talk more on this, I have with me Ashutosh Bhargava, Fund Manager, Head Equity Research, Nippon India Mutual Fund. Ashutosh, good evening and welcome to the show. So a lot has been said about Balance Advantage Funds, a type of category which is much more safer than an aggressive approach that you might have in a complete equity-oriented portfolio. Now, talking about having an exposure in equity as well as in debt, how a fund manager usually is allowed to place themselves in terms of exposure, in terms of ratio, in equity and debt in a Balance Advantage category?
Good evening. So, as the name itself suggests, there is an advantage for a typical balance fund. In a typical balance fund, you can remain invested 65% to 70% in equity, and the rest 35% fixed income. In balance advantage funds, you can bring down the net equity exposure significantly below 65% to say 30%. And that happens because of the model which is involved in these kind of funds. These model ranges from valuation-based models to more hybrid kind of models. The idea here is to reduce the drawdown, to move between equity exposure from say 30% to 80%. Based on the signals that you're getting on valuations and other trend indicators. And in that process, improve the experience of investors by reducing the overall volatility and improving the overall risk-adjusted return. So that's where these funds are placed, and this is a category which has now become a pretty matured category in some sense.
All right. Ashutosh, let's talk about your fund and the kind of exposure you have in equity and in debt. So what's the likely ratio that's been spread out?
So in our fund, we maintain between 30 to 80% in terms of net equity. At this point of time, we are at around 41% in net equity exposure. And as I said, it is governed by a model. Ours is a more hybrid approach. So valuation is a fulcrum. So as you would appreciate, valuations are a little stretched at this point of time. At the same time, some of the other shorter term indicators like dollar, global commodity indicators, as well as the overall price trend of the market itself is not very favorable. So we are at around 41% in terms of net equity allocation, which is lower versus what we have maintained the last 6 months, between 55% to 60%. So definitely slightly on the lower side. And typically, the fixed income remains between 35 to 20% in the overall portfolio. That's where we are at this point of time.
Ashutosh, how are you placed in equity across market caps? If you could just divide that exposure for us.
And it's been a more conservative category, so we are more tilted towards the large caps. So around 80% of the portfolio, the gross equity portfolio, is into the large caps. The remaining 20%, I think only 6 to 7% is into small caps. The rest is in the mid caps. In terms of sectoral bias, also, more tilted towards domestic cyclical stories, underweight on global demand taking and price taking sectors. Within the overweights, we are overweight in financials, consumer discretionary segments, and incrementally more into utility stocks also in the overall gross portfolio.
What about fixed income? How well diversified are you over there, and what's the kind of duration that we are looking at as far as your exposure in fixed income is concerned?
As a discipline, we don't take much of duration risk or credit risk in this particular fund. So typically duration remains well contained. Average duration of the portfolio, fixed income portfolio, remains contained at 3 years or below. the quality of the fixed income portfolio, in terms of credit, 85% of the assets, fixed income assets, are in investment grade category, and where most of the assets are into government or government related securities. So we are keeping, both duration and credit risk low as far as our sustainable strategy is concerned.
Also, one very basic question, which a lot of investors usually have this in mind, because if you're investing in a balance advantage category, you're also trying to take minimum risk. So when we talk about risk, how can you actually work around that and not take unnecessary risk if you are placed in this kind of a category? What is the risk mitigation process, and how does it get mitigated if you are invested in a balance advantage category, which is slightly more conservative, like your fund?
So, on a gross basis, we have to remain invested in equity. At least 65% of the AUM always have to be in, equities. Uh, but if the signals, which are based on, as I explained, uh, valuation, other variables-based signals, they indicate that this is not a right time to have high exposure in equities, and we have to reduce equity exposure. For example, today we are at 41%. So the gap between 65% and 41% is 26%. We hedge it through shorting individual stock futures. So whenever we need to reduce portfolio volatility and try to add some bit of protection, we use derivatives, and that portion becomes more like an arbitrage portion. This 26%, the hedge portion of the portfolio, becomes like an arbitrage position, and overall equity exposure therefore comes down. And this is a process which most of the other mutual funds also follow.
All right, but then now having your exposure in equity as well as in debt through a balance advantage fund, if I also have to ask you a question on the overall portfolio level, how can one actually have their strategy across equity and debt in that case, having a standalone equity and a debt exposure after having placed a balance advantage fund?
So as we just discussed that, equity and debt as a combined category, would have more volatility if you keep equity at a high level. The overall volatility would be much higher. Here, based on the model, the dynamic model, you can maneuver around this large range between 30 to 80%. And at various stages, the so-called market timing with the help of the model help achieve lower risk as well as slightly better performance over medium term. So therefore, the risk-adjusted return typically improves in these kinds of funds. And as I explained, at this point of time, given the valuation of the global challenges, in our strategy, we are keeping equity at a slightly lower level versus the longer-term average.
So, Ashutosh, talking about the tax treatment for these kind of funds, how exactly can an investor look at it?
Tax treatment remain as good as an equity fund. It's an equity taxation category where all the capital gain over the shorter or a longer period is the same as any equity fund. So 10% LTCG if you invest for more than 1 year in these kind of funds.
A very difficult question to you, but I'm sure the most interesting one for the viewers. What kind of return should be expected from a balance advantage fund like yours?
So typically, the return expectation definitely has to be much higher than fixed income over the longer period, closer to what you can achieve in a large cap equity kind of return. But the bigger idea is that it's not the return per se, is the longevity of investor to remain invest in the markets improves significantly if you come in this kind of funds where the drawdowns are lesser. So your propensity to remain invested, withstand market volatility is much higher. So if your definition of return is return per unit of shares taken, I think they are as good as equity or perhaps better. But in terms of absolute return, it will be somewhere in between, much higher than fixed income and closer to equity return, again, with much lesser pain and volatility.
All right, I think that will be all. Thank you so much, Ashutosh, for being on the show and helping our viewers with not only your fund but also the category per se as to how can they place it in their portfolio as well. Thank you so much for being on the show today. On that note, let's take a quick break, but then post that, let's talk about having small cap and mid cap exposure in your portfolio, but not via mutual funds, not via direct stocks, but via ULIPs. Is this the right thing to do? We'll get you answered all these questions with our experts after this break.